Hey everyone, welcome back to Corporate Decoder, the place where we'll figure out if this bank is truly liquid or just liquidating itself. Get ready for a deep dive into Esquire Financial Holdings Incorporated's latest financial report. We are going to unpack their numbers, understand their strategies, and see if they are truly building a solid foundation or just playing with financial Legos. Make sure to stick around to the end for our take, and hey, if you like getting these kinds of insights straight from the source, make sure you are subscribed. Also, if you want to connect with fellow finance enthusiasts and discuss these filings further, our Discord community is linked right below in the description. Alright, let's get into it. This document is Esquire Financial Holdings Incorporated's quarterly report for the period ending the 30th of September 2025. Think of it as their mid-year checkup, a snapshot of their financial health and operational performance. First up, the balance sheet, or as they call it, consolidated statements of financial condition. This is like a giant scoreboard showing what the company owns and what it owes on a specific day. On the asset side, Esquire has about $2.18 billion worth of stuff on the 30th of September 2025. That is a pretty decent jump of over $290 million, or about 15% compared to the end of last year. A big chunk of that increase comes from their loans, which have grown by about $150 million, indicating they are actively lending money. They also saw a nice boost in their cash reserves, going up by over $114 million, which is a healthy sign for liquidity. Their securities available for sale also saw a modest increase. Now let's hone in on the loans at the 30th of September 2025. Total loans, after accounting for the allowance for credit losses, were around $1.52 billion. That is a big number and represents the core of their business lending money out. The company categorizes its loans into real estate, commercial, and consumer. The commercial lending segment is the largest by far, making up about 67% of their total loans. This is interesting because they highlight their focus on the legal market where law firms are their clients. They specifically mention commercial litigation, related loans as a significant growth area. These loans are to law firms for things like working capital and case costs. This segment grew by almost 14% since the end of last year and now totals over $1 billion. This is a key strategy for them, a niche market where they seem to have a strong footing. On the liability side, deposits are where they get their funding. Total deposits have climbed to about $1.88 billion, an increase of over $237 million, or about 14%. A significant portion, almost 84%, comes from their litigation and payment processing clients. This shows how intertwined their lending and deposit gathering strategies are. Litigation clients bring in a lot of low-cost deposits, which then fund their lending activities. Stockholders' equity, which represents the owner's stake in the company, stands at about $279 million. This is up by about $42 million from the end of last year. Much of that increase is due to the profits they made during the period and a favorable adjustment in the value of their investment securities. Now let's look at the income statement, consolidated statements of income. This tells us how much money they made and how they spent it over a period. The star of the show for banks is usually net interest income. This is the difference between the interest they earn on their assets like loans and securities and the interest they pay on their liabilities like deposits and borrowings. For the 3 months ending the 30th of September 2025, net interest income was about $31 million, an increase of over $5 million, or about 21% compared to the same period last year. For the first 9 months of the year, net interest income also saw a significant jump of about $15 million. Interest income as a whole grew considerably, driven by increases in interest earned on loans and securities. For example, interest income from loans for the quarter was over $30 million, a solid increase from last year. On the flip side, their interest expense also went up. For the quarter, it was about $4.8 million, an increase of over $1.5 million, primarily due to higher interest paid on savings and money market deposits. This is a direct consequence of growth in their deposit base and likely higher market interest rates. After accounting for all expenses and provisions for credit losses, net income for the quarter was around $14 million, which is a healthy increase of about $2.7 million, or 23% compared to last year. For the 9 months, net income was over $37 million. This is a strong performance, showing the company is growing profitably. The provision for credit losses is an important number. It is the money they set aside to cover potential loan defaults. For the quarter, it was about $1.8 million, an increase from last year. For the 9-month period, it was about $6.8 million, a significant jump. They attribute this to charge-offs on a couple of specific loans, including a multifamily loan and a small business merchant loan. This is where the rubber meets the road in banking, understanding and managing credit risk. is paramount. Non-interest income, which includes things like payment processing fees and administrative service fees, remained relatively stable. Payment processing fees, which are a key part of their business, were about $5 million for the quarter, while overall payment processing volumes increased. Their income was slightly down. They mentioned changes in their merchant risk profile impacting this. Looking at expenses, employee compensation and benefits were over $10 million for the quarter. This is a significant increase from last year, and they tie it directly to their sales strategy and hiring for their new Los Angeles facility. Data processing costs also went up, reflecting their investment in technology and increased operational volumes. Now let's glance at the consolidated statements of changes in stockholders' equity. This table is crucial because it breaks down how the owner's stake in the company changed. We see net income adding positively to equity as expected. Also, other comprehensive income, which reflects changes in the value of their investment securities, had a positive impact. Specifically, unrealized gains on securities available for sale contributed to this increase. This is a good hint that the market for these securities has been favorable. The exercise of stock options also contributed significantly to the increase in equity. This means employees are exercising their options to buy company stock, which is generally a positive sign, not just for the employees, but for the company too. Let's circle back to the loan portfolio composition in Note 3. The company's strategic focus on the litigation market is clear here. Litigation-related loans now make up about 64% of their total loan portfolio, an increase from 60% at the start of the year. Their commercial litigation loans alone are over $993 million. They also disclosed a loan modification for a multifamily loan. This is important because it indicates they are actively working with borrowers facing challenges. One loan with a principal of almost $11 million was restructured into two notes, while one note was charged off. The other is now on market terms. This is a good example of responsible lending and risk management. I mean, look at this from a Warren Buffett perspective. A company with a clear niche strategy like the litigation market, understanding its risks and rewards, that's often a recipe for success. They are not just a generic bank, they are a specialized financial institution. The growth in their loan portfolio, especially in commercial litigation, loans paired with their strong deposit growth from these same clients, showcases a powerful symbiotic relationship. It is like they are feeding their business with its own profits. The fact that they are proactive about loan modifications and managing credit losses, even with a couple of charge-offs, shows a disciplined approach. That uptick in provision for credit losses for the 9-month period, totaling nearly $7 million, warrants a closer eye. But when you look at the overall loan portfolio growth and the company's net income, the health seems robust. The emphasis on technology and a digital-first approach, coupled with growth in both lending and payment processing verticals, suggests they are adapting to the future of finance. This diversification across lending and payment services can help buffer against sector-specific downturns. Their strong capital ratios, meaning they have more than enough capital to absorb potential losses, is another major plus. However, there is always a but. Increases in non-interest expenses, particularly for employee compensation and professional services, need to be monitored. While growth requires investment, it is crucial that the returns justify the costs. Also, their net interest margin, while strong, did see a slight decrease. They attribute this in part to elevated cash balances, which is a common issue when interest rates rise quickly. They are holding more cash, essentially earning less on it, which dampens their overall profitability. So is Esquire Financial Holdings Incorporated a strong contender in the financial space? The numbers point towards a company with a well-defined strategy, strong execution in its chosen markets, and a healthy balance sheet. Their niche focus on the legal and small business communities is paying off. They are leveraging technology and a relationship-based banking model to drive growth. So what is my final assessment? They are a company that understands its strengths. They are not trying to be everything to everyone. By focusing on their specialized lending and payment processing verticals, they are building a resilient and profitable business. The key will be their continued ability to manage credit risk effectively and control operating expenses as they expand. The future looks bright, but like any financial institution, staying vigilant in this unpredictable economic climate is crucial. What are your thoughts on Esquire Financial Holdings Incorporated strategy and financial performance? Do you see the litigation lending niche as a sustainable advantage or a potential pitfall? Let me know your opinions in the comments below. If you found this analysis valuable, please smash that like button. It really helps the channel grow, and subscribe for more deep dives like this. And don't forget to join our community on Discord, linked in the description. Thanks for watching, and I'll see you in the next one.